Welcome to the Tons of Industry Show. I'm terribly excited to have on the call Dave Krazler, and his free blog posts are on investmentresearchdynamics.com. His two paid letters, which are awesome, are the miningstockjournal.com and the shortsellersreport.com. And Dave is going to talk. We've talked off the air about some very cool stuff, and I'm very happy to have Dave on the call. Thank you, Dave, for being on the call.
Sure, thanks for having me on again. You mentioned that you're terribly excited. Terribly sounds like a bad thing.
No,
Hope you're
very excited.
incredibly excited.
Yes. Well, you know what? I want to start off with something we talked off the air, and that is VLWU, whatever the types of recoveries that are out there. And we talked about not an L, but a crooked L. So, can you explain to the viewers what exactly we were talking about here?
Sure. It's actually, I write about it in my Short Sellers Journal newsletter, and from day one of this virus crisis, when it became apparent that the economy was going to take a huge hit, Wall Street and the bubble vision cheerleaders have been promoting this idea of a V economy. I think Trump's economic advisor, Larry Kudlow, said the economy would be fully recovered by the end of August. And there's just no way that's going to happen. The economic damage that's been inflicted on the system from shutting down the economy countrywide for, well, I think a few states stayed open, but it was small, immaterial states in terms of contribution to GDP. I mean, that's set in motion a negative feedback loop that's just going to get uglier as the summer unfolds. And in my opinion, a big part of the underlying driver of the social unrest that we've seen is the fact that a lot of people are unemployed and they're worried about how they're going to feed their families or feed themselves at some point down the road. So you've got massive unemployment, and that takes a big chunk out of consumer spending, especially disposable, discretionary spending, and what happens is that it's like a snowball that goes downhill and eventually sets off an economic avalanche. And I think that's probably more likely what we're in store for. Now, I did say that in my newsletter, and I may have even mentioned on my blog that when the economy's opened back up, the economic data and the economic reports that come out, especially the ones from the government, are going to make it look like there's been a sharp bounce in economic activity. Now, by the middle of May, economic activity was incredibly depressed, and I think the Atlanta Fed is looking for, now they're projecting a 46% contraction in the GDP for the second quarter, and so when you reopen things and some of the people who were furloughed get reemployed, it makes it look when they express the data for May and June, and maybe even this month, in terms of percentage gains, it makes it look like there's been sharp gains in economic activity. Well, it's if your economic activity falls to a level of 1, for example, and then you reopen the economy, a meaningful percentage of people get put back to work, all of a sudden your economic activity level is 2. Well, that's 100% gain. But prior to the shutdown, your economic activity might have been at a level of 4. So, I think that, and I've said this for a while, I said, we're not going to know the full impact of what's happened. And make no mistake, the economy was going into a recession anyway, way before the shutdown. I mean, the shutdown gave the Fed an excuse to pump, $4 trillion worth of money into the banking system, and it gave the government an excuse to spend, what have they spent on stimulus so far? About $2.5 trillion, something like that. So yeah, you're going to generate a statistical bounce in economic activity. But we're not going to know the full brunt of this, of what's happened, probably until, the third quarter. So,
Yeah.
That's why I think that this idea that there's going to be a V recovery is just absurd.
Well, let me ask you. So first of all, I want to just say about what you just said. I think for the Trump administration throughout its tenure, it always exaggerates. That's like the Trump model, the best economy
Sure.
ever, the best. But he's always been on the right side of it. So it may have not been the best economy ever, but there were stuff that he can say, hey, the stock market, et cetera, et cetera. Now he's exaggerating, but it's blowing on his face. Like, we will not have coronavirus by Easter. You remember that?
Yeah.
And then at the beginning it was there's only 20 people in Oregon. It's a hoax. That was the initial comment so I think that is now playing against him a little bit. Ray Dalio
Absolutely.
was mentioning two economies, not three, but two economies. And he was saying, look, there's a real economy, and then there's credit-driven economy. In other words, credit-driven is what the Fed does, and real economy is what the jobs market is. And it's like two different things. And I liked one thing that he said in terms of, like he said, look, the credit markets, a lot of these stocks, like the FANGs, etc., they're not stocks anymore. They're safe havens. People are buying Amazon for the same reason they're buying gold, because Amazon will not default like a government can now default on you, or partial default, or change the laws, or whatever they want to do on bonds and fiat currency, etc. So, and earning season is upon us. So as we're doing this interview, the stock market is wobbling between this real economy data, like you said, and credit markets. So I think that's very interesting. And I want to follow up on that. I want to ask you a second question about what's something you've called idiot stocks. Can you explain that to me?
Sure. Um, I mean, a lot of not a lot, but a portion of the stocks that I personally mess around in, either shorting them outright or with puts, and that I discuss in my short sellers journal, are probably the same stocks that a lot of people that know how to do financial analysis and market analysis are also short. So it's stocks like Shopify, Wayfair, Carvana. My latest one is Fastly, FSLY, and these are stocks that are the modern equivalent of the .com stocks. Now, these stocks they generate revenues, and they generate revenue growth. They're kind of cloud based or internet based. They provide internet based services. Carvana has internet used car delivery set up. Now, the problem with these stocks is that they are not profitable. I mean, most of these idiot stocks have never generated a bona fide operating profit, nor will they ever. And many of them burn hundreds of millions of cash per year. I think Carvana on a trailing 12-month basis burned its operations per the cash flow from operations in the cash flow statement, burned $500 million. And they're able to survive because of all the money that the Fed has printed, since 2008, and it's left a lot of money sloshing around, especially in the private equity funds. I guess another idiot stocks refers to what is politely called unicorn stocks. I mean, these are stocks that have insanely high market cap valuations, because they generate revenue growth. But again, the basic problem with the business model of these stocks is that they don't charge a high enough price to cover the all-in cost of the services and goods that it provides to the end user. And the only reason they stay alive is because the capital markets are so flush with printed money that it has to go somewhere. So a lot of the day traders and stock jockeys and momentum funds pile into these stocks as they continue to move higher. And then at some point it becomes a self-fulfilling prophecy. Well, at some point, either the capital markets are going to stop funding these companies, or we're just going to have a general stock market downturn. And I think eventually we're going to have one that'll take us below the March lows, and these stocks are just going to get annihilated. I mean, Carvana is trading at 137. Back in March, at the bottom, it was trading at $30. Now, yeah, I'd be an idiot if I said, God, I wish I had bought Carvana at $30 or $50. But my my sensibilities wouldn't let me do it just based on fundamental valuation analysis. You can't value Carvana because it doesn't generate profits, and it never will. It doesn't generate cash flow. It's like a bloodsucker that sucks cash out of the system. And frankly, the end users of these, they're the beneficiaries. They're the ones that are getting subsidized because they're receiving and benefiting from products and services that otherwise would be a lot more expensive. So the simple way to put it is that the business models for these stocks, and I'm sure the audience knows most of them that are out there, is that they basically are giving you $1 but charging you only 75 cents. And so, yeah, of course they're going to generate sales growth, but at some point, these things are going to hit a wall and they're going to rip and reverse. So these are stocks that I tend to always have some sort of short exposure to, whether it's long dated out of the money puts. For instance, I've got September 500 strike puts on Tesla, and I bought those when Tesla was trading at 1100. Tesla's at 1380 now, and these puts have increased in value by almost $1. This morning, I bought some August 100 strike puts in Carvana. And so, and over the next 2 or 3 weeks, if we don't have a market sell off and Carvana's trading where it is or starts to move higher or continues moving higher, I'll move that put out to November or January and probably keep the strike price the same.
Yeah, so you're basically trying to bet on when this thing will pop.
Well, here's the difference, though, and I learned this lesson from I was day trading full time during the .com bubble, and starting in the late fall of 1999, I started going short these stocks, and it proved to be too early. Well, the problem is you can't time. When we're in a market bubble like this, and this is the most extreme bubble I've seen in my lifetime. When we're in a market bubble like this, it's impossible to time the top. It's just impossible. And anyone who says they did, got the top right, they either got it extraordinarily lucky or they're lying. And so I just go into this knowing I'm probably going to lose money for a while. But the thing is, you don't know. It's like that old adage, which, and I usually frown on these adages, but no one rings a bell at the top. I mean, if you go back and look at the March sell-off, it started on February 22nd, February 21st. The market started tipping over, but no one recognized that. But, I did well in that sell-off because I had been short, way before February 21st, 22nd. So what I try to do now is just maintain some short exposure to my favorite names to be short. Tesla happens to be one of them. Because again, you don't know when it's gonna all of a sudden take a huge dump.
Yeah.
And I go into it knowing that A, there's no way I can time the top, and B, I'm probably gonna lose money until I stop losing money. So, and I also know based on my experience in 2000 that as long as I maintain my conviction, I don't have to time the top perfectly. I'm still gonna make a lot more money on the downside than I lost staying involved on the short side.
Yeah, it reminds me a lot of the famous David Heinhorn short on Samsonite, where the stock went from 24 to 48 on him. He stayed short and went to $6 later on.
No, Commerce One. I started shorting that stock at 200 back in late 1999. That stock ran from $10 it peaked at 600. And then after it peaked 3 years later, it was out of business. No longer existed. The stock was worthless.
Yeah. So it will be interesting to see if we're in an equivalent time where not only are the valuations out of whack, but some of these businesses will just not make it because that's what I wanted to ask you next is sorry, go ahead.
I just wanted to add really quickly, Tesla's like the poster child example. Not only are the underlying fundamentals deteriorating quickly, the stock popped because its its second quarter deliveries exceeded Wall Street's expectations, which had been walked down for the previous 3 months. So it exceeded the expectations. Everyone gets excited. Guess what? On a year-over-year basis, its sales declined, and that's with the introduction of a new product and the opening of China, to the Model 3. So its sales declined. Its sales declined everywhere except in China. Yeah, in some markets in North America and in Europe, in the EU, its deliveries declined 60-70% on a year-over-year basis.
Okay, I want to really ask you, Dave, about socializing losses. So in 2008, we saw the first example of this. We, as a society, at the end of the day, society agreed that the banks should be bailed out, whether or not the majority believed that or not. There wasn't enough public outcry to stop bailouts, and they happened. And then zero interest rates, negative interest rates, QE. And it looks like the public is agreeing to a lot of things. Will it continue to agree to what's happening right now? In other words, to basically what the Federal Reserve is doing, it's bought all the debt for the Russell, for the Russell 3000, for the Wilshire 5000. It's gone in and bought all the junk debt. It's literally forbidding business failures because of coronavirus. In other words, if your business is doing poorly just because of coronavirus, or predominantly or in majority part by coronavirus, they will not let you fail. They're calling it making you whole. Do you agree with that? Should this be what society does? And what is the limit? Where is that point, Dave, where the Fed creating new currency is the alleged benefits of it are so small that you can visibly see it creates more damage? What would be that point, in your opinion, either in public perception or in their own internal perception?
Okay, that's a complicated question. It's a good question. So what happened back in 2008, I mean, it was a true socialization of losses, because one of the first things that happened, if you recall, was that there was an $800 billion bank bailout bill passed through Congress. And Bernanke and Henry Paulson and a couple of those other criminals went and scared the shit out of Congress, and made them think that we gotta keep the banks alive or the whole system's gonna crash. Well, that's a bunch of BS. But the public, most of the public, they didn't understand what was really going on. It was a bailout of the banks and nothing more. Main Street did not benefit at all from the Fed money printing or from the $800 billion taxpayer bailout. So, and the public, it's not that they don't understand because they're stupid. It's they don't understand because most people are not interested in finance and markets, and unless the stock market's going up, then everyone becomes a stock jockey genius. But they didn't understand like the true dynamics of what was going on. And when you're told, oh, geez, we have to do this or the whole system's going to collapse and it's going to be economic Armageddon, well, fear's the best motivator to get people to go along with what you're trying to get done, right? Fast forward to this time around. So the bottom line is the banks' massive losses in all of their horrible subprime type investments and derivatives were socialized by the taxpayer. And if you recall, most of the banks paid themselves huge bonuses at the end of 2008. Those guys, there should have been no bonuses paid, and the banks that were in the worst shape should have been allowed to fail. But this time around, it's the same thing. I mean, let's make no mistake. Most of the money that's been printed has gone right to the banks. It hasn't gone to Main Street. And instead of outright doing a congressionally passed taxpayer-funded bill to bail out the banks, they did it in a sneaky backdoor way. Steve Mnuchin on his own had the Treasury guarantee or put in 10% of the capital that's being used to buy all these bad assets off bank balance sheets. But the problem is that the Treasury also guaranteed the Fed against losses that it incurs the 10% is just a cushion, but ultimately the Treasury is going to be liable for, it sounds like, I think, all the losses. I don't know if there's a demarcation between who shares the losses between the Fed and the Treasury. I think ultimately the Treasury, or I should say the taxpayer, is at full risk for losses that the Fed incurs. And so that's an even more devious socialization of bad bank investment decisions. And this one is like they've pulled the wool over the eyes over most of the taxpayers. Now, to address the second part of your question, will the public care this time? Well, interestingly, I've been thinking a lot about this, and it's Trump's made it pretty apparent that he thinks the stock market is the economy, and if the stock market goes higher, it means he's going to get votes. And it's been obvious to a lot of us for a long time that Trump bases his ability to get reelected on whether or not the stock market keeps going higher, and that's total nonsense. Because I think, and again, this is just my theory, but it's just observation of the public. I think you've got a very large percentage of people who have not benefited one iota from anything Trump's done, starting with the tax cuts. I mean, my taxes stayed the same. My tax payments versus last year after the tax bill was passed, and my earnings have been pretty constant year to year. I didn't get any tax breaks. Most of those tax breaks went to corporations and billionaires. And so I think you've got a large percentage of the people who are now, unemployed, and they don't have hopes of getting reemployed. People who were furloughed, rehired, are now many of them are being let go again because the economy is not recovering in a material way. And I actually think that people, they might not know like all the details of what's going on in terms of the way the funds are flowing, but they see the stock market going higher and they know they're not benefiting at all from it because most households don't own stocks. Maybe they have a small 401k plan, but most of the stocks are owned by the upper 10%. And of that, most of the stocks are really owned by the upper 1%. So I think, driving the stock market higher like this, and when it's pretty obvious what Trump's doing, I think that's going to piss off a lot more people than will benefit Trump from pushing the stock market higher like this.
That's
so yeah, I think the general masses are the better they see things getting for the very wealthy, the more pissed off they get because it's not getting better for them, and it hasn't for the last 4 years.
Interesting
So
observation.
I think it's going to work against him, and I would argue that's a big part of the reason why Biden has a 10 to 12 point lead on Trump, depending on which poll you look at.
Sure. Okay, that's really interesting observation. I want to talk to you now about gold, silver, gold stocks.
But
in the
I
remaining
thought
time we
gold
have.
was a barbarous relic. Warren Buffett said it just sits there and does nothing.
Yeah.
How can that be interesting?
I'll tell you what. What's really interesting is that yesterday was the highest close for gold USD terms in history. In other words, if you bought gold at any point during human history, especially under USD terms, you are up. That is an incredible stat. In 2011,
it actually didn't quite get as high as it got in 2011.
No,
but
it didn't. But
right.
on a closing visit, in other words, end of day.
On a close. Okay, right, got you.
The 2011, it was a blow off top, and then it
yes.
immediately. So nobody really cared. So what I want to ask you, big picture, is this much different than 2011? Are we at the start of something big? Or are you feeling like this is something that's developing, or is this an end of a move because of the coronavirus?
Sure. Now, again, the mainstream financial media was pointing to the coronavirus and using the fear of the virus as the cover story for why the price of gold was moving up. It had nothing to do with the coronavirus. Gold moves. The main drivers of gold are negative interest rates and currency devaluation, and those two are not separate items. They're intertwined. Negative rates and currency devaluation. Negative rates are a de facto currency devaluation, but gold is moving up. So originally, I was thinking that we're entering a period that's similar to 2008 because gold hit 1,020 in March 2008 and got taken all the way down to 700 by the end of October. And then, that it was, if fear was the motivator for gold going higher, you would think that the collapse of Lehman Brothers would have sent gold to the moon. Well, no, the price of gold continued to go lower after Lehman collapsed. And that's because the people in positions who make these kinds of decisions knew that they were going to have to start printing a lot of money. In fact, I would bet good money that the Fed was already scripting its plan for printing money early in 2008, if not before that. Because, your first tremor that something was wrong, the first tremor telling us something was wrong in the financial system was the collapse of Bear Stearns. I mean, that was a stunning collapse, $60 to $2 in like a day or two. After Kramer came out and pounded the table on it as a strong buy at 60. So at any rate, gold started discounting the fact that there was going to be a lot of money printing, and it ran from, starting in late 2008, it ran from 700 up to 1900 by 2011. So I was thinking, the move that we're on the cusp of seeing was similar to that. But actually, I've kind of changed my thinking on it. Now, the move that we saw from 1200 to 1800 in gold, that a lot of that was the market coming to the realization that the Fed is going to have to start printing probably ultimately a lot more money than it printed between 2008 and I think 2015 is when it stopped printing. But I would liken what's, the relative value of the precious metals market and gold and silver and mining stocks. I think we're more akin to where the market was, say, in 2003, so 2002. So I look at the first stage of the gold bull market going from 2000 to 2011. We had a 5-year, basically a 4.5-year corrective period. I mean, gold went from 1900 down to 1100. And right now, it seems like the big barrier that it needs to get over is 1900. And once it does that, it's going to really take off. It's similar to the way it was back in 2003, late 2003, 2004, when gold was trying to push over 400. And back then, Robert Prechter, this is a true story. And I may not have the time frame exact, but probably about a week before gold pushed over 400. And it bounced its head on 400 for the better part of a year. It hit 400 and sell off, hit 400 and sell off. Kind of like it's doing with 1900, although, it's really more like the high 1800s at this point on a futures basis. But at any rate, I would say it was probably within a week of gold pushing through 400 for good. Prechter issued a call for gold to go to 50. He said gold was going to go to 50 and stay there. So I think the current time period, even though we've had a big move already since really since probably August 2018, but especially since mid-March this year, I would say that we're kind of where we were on the curve back in 2003, 2004 in terms of the possibility for this bull market and how long it could last. I guess the bottom line there is, I think if people think that they've missed a big run, well, you haven't missed a big run. I mean, the Huey index just pushed over 300 in the last week. It peaked at well over 600 in 2011.
Yeah.
And I think it's going to even go much higher than that this time around. So we're still in the early stages of what I think is going to be an extended bull market. And it's going to have to do with the Fed's, make no mistake, the Fed's going to have to print a lot more money. And the government's going to have to issue a lot more debt and go into even more deficit spending to try and keep the whole system from collapsing.
Yeah.
And that's what gold's showing us. Gold doesn't care about the coronavirus.
Understood. Dave, in closing, can you tell people exactly where they can check out your work and what's it all about?
Sure. So as you mentioned at the start, my blog is investmentresearchdynamics.com, and I post a lot of times. I'll post snippets from my newsletters, or when I really need some therapeutic couch time, I'll write an in-depth blog post that I put up there that's not connected to necessarily gold or silver or shorting Tesla. And then I also have the Mining Stock Journal and the Short Sellers Journal. The Mining Stock Journal is a bi-weekly, twice a month newsletter, and the Short Sellers Journal is a weekly newsletter. And you can get more information on my blog on those two newsletters.
Dave, thank you very much for taking the time today.
Lior, thanks for having me. It's a pleasure.